Let's go. Let's go.
That's it. Good morning, everyone. We don't have Dave this morning. I have to admit, it's going to be hard to fill his shoes because for me,
Scott, we don't have Scott.
I'm sorry, Scott. Right? It's to fill his shoes because for me as a biker in Miami, when I'm listening and riding and it's through traffic, he's a voice that I can always hear. He's so distinct. But so I think this is just going to be a round of the Three Musketeers or the Three Stooges, and probably the Musketeers. But we kind of thought, we all know the data in the U.S. was very strong Friday. Let's not beat that horse. What I see significant, I think we might want to dig in a little bit, is first of all, we've had the great information from the U.S. So we had our GDP increased about 1.5 trillion last year, and our debt increased about 2.6 trillion. That's not so good. But the great reset that I really started talking about almost 2 years ago has not happened in the U.S., thank God, but it's really happening in China. I mean, completely a depression potentially kicking in. And one of the data points I want to mention this morning is, first of all, the HSC, or the Hong Kong Shanghai Index, is the lowest versus S&P 500 since 1975. To put that in context, Chairman Mao died in 1976. So that's pretty bad if you're holding any type of wealth in China. And this week, on Friday, we had the Miami Economic Forum. So a little inside scoop. One of my primary goals there is to get any kind of inside feeling, investment feeling for China. It was as bad as I thought it would be. And one key person who spoke was Eric Bethel, former executive director of World Bank. I actually had lunch with him and just pointed out how bad it is. So I've kind of given up a little bit all my research I've been doing on China because I'm somewhat concluded that it's a Great Depression kicking in. And I don't know what stops it. I don't know what that means so much for the US, but I think it's quite good for crypto dollars and Bitcoin and gold and things like that. But to tilt over to the US, our morning meeting this morning pointed out our equity people show the U.S. equity market kind of in manic mode now. And they said that back in December for a little while and caused a pause. We got that gap in the S&P 500 E-minis down to 4,600, which we've never had those gaps, those holes not filled. But from my standpoint, I'll tilt over, do my commodity outlook and go to you guys. I see nothing but significant deflation continuing commodities. It started in the grains where it should be. It's the most elastic sector. It's kicking in industrial metals, mostly because of China. And the laggard on the way down has been crude oil. And I fully expect that to catch up and go towards about 50 for that immaculate deflation from commodities. But there's the key fact I think I want to tilt over to my colleagues to tilt on that I figured to tee you both off is the fact that we're doing this wonderful thing in this country that we're getting less and less GDP growth with more and more deficit spending.
Yeah. So we wonder why we haven't had any landing, right? So yeah, first of all, thank you, Mike. And it's too bad we don't have Scott to tee us up with an exuberant intro. But if you look at the jobs number Friday, it was so noisy. And Dave, I think you and I might have talked about this on Twitter a little bit, but I mean, just starting with the number itself of 353,000 jobs. I mean, it's nonsensical, first of all, but let's just pretend that that's kind of a real measure that they have. If you just look at there's two surveys that they do in the jobs report, and one's an establishment survey and one's a household survey. And for the listeners to understand, the establishment survey is when the surveyor, the person on the phone, actually calls or issues a survey to somebody on email that they're asking a company about their job situation. Have they been hiring? Have they like what their situation is? And then the household is they're asking individuals. So if you're an individual that has multiple jobs, you can get double counted in the household survey, which points to the fact that when you look at the part-time jobs that surged by 96,000, right? And then full-time jobs declined by 63,000, the divergence between those two is growing. And it makes sense now, right? Because you're getting a lot of people taking 2 and 3 jobs instead of there just being a lower unemployment rate. You're getting people taking more jobs to keep up with the economy, or keep up with inflation. So it's noisy. It's not perfect. It's super imperfect, actually. And then when you look at the average hourly earnings that increased, the hourly increased because the number of hours worked decreased. So it's a difficult number to pin your hopes on on the economy still burning along here. And I don't take it on face value. Let's just put it that way.
There's an old Wall Street expression, and it used to be a Wall Street expression. Now it's basically the face of government. It doesn't matter which administration's in power, they're going to do the same thing. It's the idea of putting lipstick on a pig. And when you look at what's going on in the economy, that's where the divergence is. I mean, I saw someone wrote a tweet that said, isn't it amazing how all the academics say that the data is great and everybody should be happy, and the majority of people in every opinion poll are unhappy? And, you have to look at it. Now, look, there are divergences around the economy. There's different areas. There's pockets of strength for sure, right? And there's pockets of weakness. But the single biggest obvious thing is what we consider full-time employment at under 36 hours is fascinating, because there's enough hours in the week. I mean, my first job at Morgan Stanley, I worked 80 hours a week. Okay. Well, Wall Street, whips and drives us. So I should have counted as 2 full-time jobs, because at the end of the day, in the survey, you could do it. So if somebody works 35, 36 hours a week in a job and drives an Uber 35 hours a week, that'll be 2 full-time jobs. And so, you basically spend a whole weekend driving an Uber and a couple of nights, and there you go. And so it's really noisy data, and we know that. The real issue that everyone has to understand is monetary inflation. I tend to agree with Mike that commodities have a boom-bust cycle, which will always cause commodity deflation. That's totally separate than the fact of monetary inflation. And let's make no mistake, I've been saying this for as long as you guys have known me, and a long time before, that policymakers, starting with Trump, were idiotic in dumping helicopter money on people. And what followed with tight supply chains was completely predictable. And what they want to get back to is monetary, i.e. asset inflation, and consumer deflation. Because when assets inflate, you get malinvestment, i.e. excess investment in technology and things that accelerate that boom-bust cycle in commodities. At the same time, the wealth effect is there for those people who are lucky enough to own wealth. The problem is that most of the stock market, virtually all the stock market, is owned by the top 10% of people, and a pretty hefty part is owned by the top 1%. So that's the only thing that explains the data. But, look, at the end of the day, the U.S. is certainly the best of the bunch. There's no question about it. Our economy is doing better than Europe. It's doing obviously better than what's going on in China. But the truth of the matter is that what's doing well is uneven. And I think that's the best way to look at it. And, we'll see as we go into the meat of the election whether it actually matters. Because, one side is going to talk about the economy and the other side isn't. One side is going to only talk about the personality of their opponent, and weird ideas of threats to democracy, and we could go into all that. But the fact is that the Fed, the thing that neither of you guys mentioned, and I didn't watch it, so I've only seen reviews of it. I suppose I will if I'm forced to. That the chairman of the Federal Reserve going on 60 Minutes and talking up the economy is, did Greenspan ever? Did anyone else ever do this, guys? As I don't remember it. But that I've been saying the Fed is going to be political and is going to do everything they could to be, if not accommodative, at least neutral by the time the election gets into full swing. And if that doesn't prove that I'm right, I honestly don't know what other proof other than watching it happen in real time could be. What do you think? Am I crazy in thinking the Fed that Powell going on 60 Minutes is kind of important, in terms of signaling that they're going to be political and involved? What do you think?
I recall Ben Bernanke did it during the height of the Great Recession. James, do you remember that? I think we all kind of remember that, and it helped soothe things. It was a perfect transition to President Obama, because he caught, you always want to buy a company when it's failing. All you have to do is fix it and do a few little things. It worked out really well. But now I guess I'm less in the conspiracy thing than thinking that what now is the lessons that Ben Bernanke taught us in that book, The Courage to Act, is the Fed will always just throw massive liquidity at something. That's exactly what they did during when we hit the pandemic. And now, we threw too much liquidity. We're taking it away. But I have to admit, the most thing that came out at the conference that any of us, the guy asked the question, who was sitting here 2 years ago, thought we'd have the latest GDP number for this quarter after the Fed raised 500 basis points in the fastest pace in history. Hand raised, no clue, never seen that before, didn't expect that. But where does it go from here? And that's where I think the biggest thing I want to show, and maybe we can tilt over a little bit, Misha, if you want to show this chart that I'm concerned about, is just simple little things. I want to tilt over to what I know we want to at least get to, and that's markets outlook. Like I said, I show my outlook is we're going to see more deflation in commodities, which is good fuel for the Fed to ease rates. But
before you go there,
yeah.
Mike, just finishing out Dave's thought on the Powell going on national television and talking about monetary policy and insisting that it does not coincide with fiscal policy, right? So that's number one. So what is he doing? Why is he up there? Why is he? Because he needs to instill confidence in the Fed and the process and the U.S. dollar in order to to facilitate fiscal irresponsibility is basically what's happening, right? Because he said it, he admitted it. I even put a tweet out about it last night that we are on an unsustainable fiscal path in Congress. He said it. He admitted it. He also admitted that there are pockets of major problems in commercial real estate. They know that there are problems. However, he said that he believes it's contained. So what does that mean? That means that he expects that some small banks are going to be sacrificed in this round of real estate crisis, and that they're going to be swallowed up by larger banks. And they're managing it. They're on top of it. They're managing it by facilitating that process. They're in there figuring out JP Morgan's going to take this piece, and Wells Fargo is going to take this piece, and Citigroup's going to take this piece. That's what they're doing in the background. They're trying to figure out how they're going to manage this $1 trillion disruption in the commercial real estate market. Okay, so put that aside. And then finally, nobody has asked him this question, and it has blown my mind. It has blown my mind that nobody's asked the question of, why did you strike this sentence from the press release? The U.S. banking system is sound and resilient. Why did we strike that? Why did we take that out of the press release? Now, I talked about it in my newsletter. I personally think that, they had planned it. They had said, well, we put this in back in March in the Silicon Valley banking crisis. We put that paragraph in to reinforce that, hey, we're on top of this. With the U.S. banking system is sound and resilient. There's no reason for any run on banks, whatever. And then they took it out at the beginning of this year because it's been in there for 9 months, 8 months, something like that, right? So they took it out, and now the same, literally that 2 days later, or the morning later, you have the New York Community Bank Corp collapse, right? So people are thinking, well, does that mean that it's no longer sound and resilient, or was it just they had planned it? Now, I believe they planned it and they just haven't addressed it, but it has absolutely blown my mind that not one reporter, nobody asked them this question. Why was that taken out? What do you guys think?
I think Shakespeare summed it up. Methinks thou doth protest too much. I mean, just think about it for a second. Bernanke went on when the world is falling apart. Powell goes on telling everyone everything is okay. I mean, inflation is transitory. the mortgage market is strong from Yellen, before this.
Commercial real estate is okay.
Everything is fine. You have to ask yourself the question. It's just like you both have made the point many times on this show, and it's really an important one that people keep forgetting, which is when the Fed starts cutting, it always is coincident with the market getting just basically shitting the bed. Okay. Yeah. So what do we have here? We have, the Fed starts jawboning because they see what people don't see. We saw a huge employment report and everyone's saying, oh, the U.S. economy is healthy. That weekend, the chairman of the Federal Reserve comes on to say everything is okay. Well, wait a minute, but we all thought everything was okay. What's the problem? Well, the answer is he knows it's not okay. And he's telling people that when they start seeing the cracks, things are going to happen. Honestly, there's no other way to look at it. I wish there was. So you have to ask yourself the question, which is what's going to happen next? And in my opinion, and I think, James, you're saying the same thing, the answer is the liquidity spigot gets turned back on. I mean, I was just looking this morning at M2. M2, it's going back, and when you have to do the zoom out. So hold on, let me just share this. I'd love to hear your opinion on this, Mike, and you probably can get much finer grain than this. But when we do this Chrome tab, okay, so this works, right? You guys, we can see it. Yeah, here we go. So this is the zoom out version of M2. Basically you have from 95, the bull market started, kind of after the crash here, and it just kept meandering up. Then we have the pandemic, bam. But then look at even after the BAMO, how steep it was. Then we have this little, we're going to be able to take money off the table. And so let's zoom in and look at that. And so now you see the BAMO and then the money off the table. It's pretty small. and when you look at the last year, it's like, we had a few months of down, then bottomed, and now it's starting to tick back up again in December. We don't know what January is going to look like. But my guess is February and March are going to look a hell of a lot more like up here and beyond. Because they know that, right? And particularly with what's going on in China, that's going to matter, right? And so it really is important to understand and look at liquidity. And we're not even talking about the reverse repo. And I'd be curious what you guys.
Yeah, and we're not even talking about the massive deficits we're running in. And you actually posted this in our little conversation this morning. We're running greater deficits than ever before. And we're not even we're not in a recession. We're probably in 5 wars, but we're not in a recession, and we're running. What was the data point, Dave?
Well, we have the biggest deficit ever in peacetime non-recession.
Yeah,
as a percent of GDP. It's not even close.
Right. So you're wondering, so all the Fed governors and officials are, they're all out there trying to figure out, well, where is this neutral rate? Like, why is the neutral rate seem higher than before? The neutral rate, for everybody on the show, we've said it before, but just as a reminder, that's where the interest rates from the Fed funds rate it's neither accommodative nor restrictive, meaning it's not expansionary or restrictionary, right? So it's just kind of neutral. That means if they keep it there, the economy should kind of just plunk along. Well, they've always said it's about 2.5%, or they've said in modern history, it's about 2.5%. And now they're all wondering out loud, has that moved up? And why? Why has it moved up? Well, these are all major factors. When you're running massive deficits and your fiscal deficits, that's inflationary. It's stimulating the economy. You're borrowing from the future to stimulate the economy.
Yeah, thank you, Misha, for taking to this chart. I just want to piggyback on that. This is what I started playing with this weekend. Is you just take a real GDP, which is running 2.5% real, and you add the budget deficit, which is negative. And this is just to make your point. Right now, it's we're getting negative 4% GDP if you add in the deficit. The last few times we got that, we had recessions. And I want to overlay a similar chart. I took this.
Look at that. Wait, go back to that chart. Go back.
Yeah.
Look at how the recessions begin.
Yeah.
Look at.
so you add to that.
Like we just sailed right through by having deficits without admitting that 2-quarter recession that we started into, right?
Yeah. So you add to that the Salm rule about unemployment. I mean, just bottom around what 3.4%, and usually goes up to about 6. We still
Right.
have the inverted curve.
But yeah. So the SOM rule is that you have to have a 0.5% increase from the bottoming out of your unemployment rate in that cycle. So in this cycle, it's what 3.4% you said. So we need to get unemployment to 3.9% in order to trigger the onset of a recession. That's the SOM rule. Okay, sorry.
And so I'm glad you explained, because to not get unemployment to keep going up, we need to spend an extra 4 to 6% of GDP every year in deficit. And I kind of played with it. This is one thing I did this week, and I want to play with this. If you look at U.S. nominal GDP, that's nominal in dollars, and you divide by public debt that we're spending, it's it's $6 trillion. It used to be kind of flat. So if you do this and you invert it, overlay with gold, that to me is a chart. It's like, okay, just invert that, and there's gold. Like, gold's just very happy to say, okay, thank you very much. I'll hang out here for a while. But let's just tilt over what's happened recently with the Fed, and we can dig in there. This is the March meeting. They were at 60%. Now it's at 20%. And May is effectively almost 100% that we're going to. No, actually, still not. It's only showing 20 basis points of cuts, not 25 yet. So by June, we should be cutting 100%. And we've been hearing this for what, year and a half now, that they're going to keep cutting the dangling carrot of cutting. And it's just not happening.
And he said, and Powell said on 60 Minutes, you didn't hear this part, Dave. He said, he figures 3 cuts this year. So 75 basis points.
There you go.
Well, to me, if we wait until, so that means that you're waiting until June, July, right?
Probably.
And if you wait until that long, you're probably getting
amazing how the 3 cuts will all happen right when after the candidates are chosen and we're going into
about a month. He was saying about a month or 2 before the elections, and that's when that question came up of, are you political? And he said, no, we're working on our own timetable, whatever. Let's put that over there. Pretend that there's no political pressure from Warren.
Come on, James. It's just right. He's going to time his 3 cuts for the 3 meetings that take place during the general election run up. But no, they're not political. Sure.
Yeah. But to me, it's he knows he's walking this line of, hey, I've got to make sure that inflation doesn't flare up again, and I want to make sure I protect my legacy, because I'm probably not going to be in the seat after this election. And then if I hold up too long, we know that I'm going to be cutting rates not at 25 basis points, but 50 basis points a clip next year, right? So that, because we are headed deep into a recession. So that's the he's just kind of balancing. He's doing a balancing act between those two. Sorry, Mike, go ahead. So, but just to clarify on that. Yeah.
I wanted you to clarify, because I want to tilt over to, this is what I think the market's thinking, and it's from the world's most significant leading indicator, and that's Bitcoin. Is what you just said is what used to happen is they would drop rates on the elevator and they went up on the escalator. That's reversed. We went up on the elevator, and right now we say there is no reason to cut rates until markets make them. And that's why I'm still worried about these simple little quirky things. We can talk macro. Here's micro. This little gap in the S&P 5 E-minis at 4,600. It's never happened. I remember trading these at a hedge fund. That was our benchmark for beta. So that's a weekly chart. And then I overlay that with what I'm concerned about. And I don't know if we want to go into that too much, because I don't want to get Dave too mad.
Well, but that's really interesting, Mike, because on Friday, more stocks were down than were up, and we still were making new highs. So
I think the underlying markets are getting it, and that's why I'm worried. I want to see this Bitcoin show it's going to outperform the S&P 500, and I see all this hype and everything. Oh, they're going to buy. And if I'm an RIA and I'm making money for my clients in Qs and on a risk-adjusted basis, I just think there's no hurry to be reallocating over the Bitcoin until it proves that I'm going to beat the Qs on a risk-adjusted basis.
Well, I think that's right. I also think that the Qs still are dependent somewhat on people's outlook on the economy. Yeah. And there's still an earnings tether, and Bitcoin is a pure, just like your chart of gold, Bitcoin is pure hyperbolic speculation against government deficits and confidence in government. And that's when that has been my thesis all along, that after this election cycle, Bitcoin will delink. And I'm not changing that anytime soon. I think Bitcoin will ascend to rival gold at some point in the next 2 cycles. And that's a big deal. And that's what the investment is. I mean, they're very, very different. And just keep in mind, the entire Bitcoin market, we talk about it because it's liquidity on the weekend, et cetera. It's still smaller than Apple, right? You know, it's smaller than one stock. And Apple, it's funny, you know, I haven't used the new, I'm not going to spend $3,500 for a pair of ski goggles. But you know, the truth is that the new version? Are we on our way toward, you know, implanted chips in our eyes to do augmented reality, or is this another Newton, which nobody really wants to deal with? I don't know, but at the end of the day, it's kind of a big deal. But no, the point of Bitcoin Gold is like, look, you know what I think. We'll talk in 11 months. We'll see where it is. And I expect Bitcoin to outperform. I actually think both will perform well. I just think Bitcoin will perform better because I think that we have rocky roads ahead.
Yeah, and I agree with you. Like the monetary expansion is just rocket fuel for.
I mean, just look, the thing that I'm looking at today is the 10-year back up over 4.1, and, you know, dropping a point. I mean, you know, that is triggering panic. Because the 10-year, if you look at the curve right now, yeah, okay, you know, we are down. We have a 1.2% difference between 1 month and the 30. Actually, at 1% between 1 month and the 30-year, and 1.2%, you know, inversion between 1 month and 10 years. So you got to figure that's going to come out. I mean, the issue is, does it come out because, you know, we lose control of the 10-year and our budget deficits get to crazy levels where we cannot afford, where basically every bit of discretionary spending is crowded out? You know, it's problematic. I mean, they need monetary inflation. Need. This isn't a question of want anymore. It's need. You know, because you can't austerity your way out of a budget when it gets to these levels. You just can't. You have to grow your way out. And growing, it needs to be in nominal and real terms, but
let's talk about that. Yeah, when we both know that the easiest way for them to do it is on nominal terms. So to allow for either high perpetual inflation or some sort of very large spike of inflation, period, right? And I don't know, no politician wants that. So rather what they would do is just kind of fudge the numbers, lie about where inflation really is, allow it to run a little bit hot, so you have an expansion in your GDP on nominal terms, and you're taxing those dollars. And so I think they're going to do that in perpetuity. You know, that's the easiest way to do it. Just keep borrowing, keep issuing debt, keep running these deficits, and allow for inflation.
So now here's my question, Mike. I want to tee you up. How does the fact that China can't afford to buy our debt, and they've been selling our debt actually because they don't hold as much, how does that impact this?
So I'm glad you brought that. That's what I pulled up as we were speaking. The U.S. 10-year note yield versus China's 10-year note yield. It reached the lowest in our database since 2005 this morning. So that great reset, that great depression is happening in China. Now, as far as buying our debt, yes, they've been one of the biggest buyers and have been, but before it was Japan and then it was England. It always rotates, and it always comes down to fair value. It's the deepest pockets on the planet. You're getting 200 basis points more than the and in the U.S., you're getting 200 basis points more than the second largest economy world, which we can't really invest in. You're getting many times you get in Japan, yet 2 times you're getting in Germany. It's just unstoppable, that the dollar and U.S. treasuries, and then you have that umbrella of U.S. protection. But the way I see it is, this is a global economic potential depression. It's already starting in China. It's already started in Europe. And the just question is, how long can the U.S. remain above the fray? And I look at it, this 10-year note yield in the U.S., it's very near the highest ever. Yes, we have this debt to GDP problem, but of all the other countries in the world, it's the least worst. I mean, and who's got the exorbitant privilege? I think the risk is that the U.S. just follows China on the way down and heads towards a 3 handle, maybe by the end of this year. And that's all. that's the kind of thing. All it takes is just like we mentioned earlier, just a little bit of hiccup in this extraordinarily rally in U.S. risk assets, and just a little bit of that tilt towards what always happens historically when you have this kind of deficit spending and this kind of yield curve stuff is recession. But of course, then we have President Trump coming in saying he's going to add a 60% tariff on all Chinese imports. I mean,
Well, yeah, I mean,
maybe teeing you guys off, and you too, Dave.
they kidnapped Scott. So, and that's
Ollie.
Yeah, I mean, well, look, and you both know this. You've seen this. We've seen it in every single modern cycle where the Fed lowers rates, and then within a period of what, 6 to 18 months or 24 months, we head into a recession, and the market does sell off. The market sells off after the Fed pivots. We've had in the last 4 pivots drawdowns of between 15 and 50%. So, like, it's just, Dave, you made the comment earlier, like the market just we have memories of goldfish. Like, we just keep forgetting this. Like, how do you keep forgetting that the market goes down after a pivot? And so the market's asking for a pivot. They're waiting for a pivot. They're asking for a pivot. And what everybody wants is a pivot before we have a crash landing. That's what the market is saying. And then on Friday, the exuberance was, hey, we're not going to have any landing. We're not going to. We're just going to keep going. And so, yeah.
So I just added the S&P 500 to that chart. Once you start cutting rates, it's not the place you want to be. Like you said, it pivots. Okay, rates started going down, yields started going down, S&P 500 peaks. This is 2008-9. Same thing. Well, obviously this was a bit of a distortion, the pandemic, but I can go back to 2000. It's the key thing is also, I look at it too. Maybe I'll tee you off on this too. Last year at this time, the S&P 500 was about a 20% discount to all-time highs. Now what? What do you got to look forward to? Good luck. You got to ride that wave, and it's obviously the wall of uncertainty. And then I look at simplistically, you got these little gaps below the market.
Right. And I'm not a bear by nature. I'm optimistic, but the thing is, what you just said is we're kind of priced to perfection here.
Oh yeah.
We're priced to a perfect landing. Like we are waiting for that, Nadia Comaneci 10.0 hit the landing. We're waiting for it,
But it depends when you say we, and I think that the market is
we in the market. Yeah, exactly.
I think that there are people out there legitimately who look at this and say, well, look, the stuff we're actually buying, the stuff we're actually investing in are going to keep making more nominal money because of what's going on in tech and AI and new and stuff. The U.S. is the little engine that could, but it's actually the big engine. I mean, when you talk about the difference in U.S. and Germany, and Germany is reasonably around, but look at the rest of Europe anyway. When you talk about the difference in yield, well, that's because we have the reserve currency, and so that is the penalty we have to play. The fascinating question will be what politicians actually start looking at this and mistakenly screw up and say things that could imperil that reserve currency. I actually don't think they will. I think all this talk about BRICS and whatnot, it's a political issue, but I think it's bullshit. I don't know. How are you going to anchor a currency on an economy that basically is tipping into depression, as Mike put it? I mean, good luck with that is the sort of answer. I mean, I personally think more and more people in the periphery will start opting not out, but opting into things like Bitcoin. I mean, look what happened in El Salvador this week. I mean, this is non-true. If you think there aren't a bunch of countries around the world looking and saying, okay, wait a minute. So this dude decided to become authoritarian and sweep out crime and corruption, make Bitcoin a standard, attract a bunch of lunatic Westerners down to his country. And now he's winning with 80% of the vote or 70% of the it's just massive landslide and really improving the country. I mean, it's not like this is a question. No one's talking about it. I mean, in fact, we get Ilhan Omar saying how bad he is. I mean, which talk about an endorsement from my perspective. I mean, you can't get a stronger endorsement, but it's not a trivial problem. But that's the sort of thing that takes time because it starts with, small countries. And then, we'll see what happens in Argentina with Milei. the fact is there are people all over the world looking at this. This is not going to be the kind of thing that changes the dollar hegemony because, you know, France or Germany or China even or Japan does something. It's going to be from the smaller countries back on in. It's a much longer term process, but it's not trivial. It is not trivial at all. You know, The Economist, you know, keeps writing articles saying about how Bitcoin is stupid. I mean, okay, you know, I don't want to debate these guys because essentially they're acting at like a third grade level, which is sad because The Economist used to be one of the best publications on the planet. But the things they've said are so sophomoric and dumb that it's anyone watching this who knows anyone at The Economist, you want to get the person who wrote that article on this show. I don't think they'll have a very good time because you can't really defend stupidity very well. But the fact is there are things going on. At the same time, I mean, James, you and I and Mike, we're all making fun of budget deficits. We're making fun of what we're doing here. But the fact is the Fed is doing what they need to do. They're trying to engineer what Mike said. They want their dream is to bring the long rate down under 3%.
And they know that they've got runway. Going back to what you were saying about the reverse repo, there's still there's still $500 billion sitting in reverse repo, right? So what is happening? The Treasury is going to continue to issue T-bills, which are very short-term bonds, in order to draw money out of that reverse repo. They've got time. What the Fed is worried about is, if you're thinking about timing, the Fed is worried about that reverse repo getting down towards zero, which means that banks are going to have to start dipping into their reserves in order to buy bonds. And unless they just keep, you keep re-upping on your T-bills, which they will, but we're running in a deficit, which means we have to continue to borrow more than we're paying off, than we've already borrowed. So we have to continue to issue more bonds. So they're going to have to start dipping into reserves. And reserves are at what now, Mike? 3.5 trillion, 3.2, 3.5, somewhere between 3.2 and 3.5. I can't remember what the number is.
You watch
right
it
now.
More closely than I do. In fact, I trust you on this
it's
program.
somewhere, but when it gets down to be around 2.5 trillion, that's when the Fed starts getting nervous. Why? Because back in September of 2019, you all remember the repo rate spiked straight up because there was illiquidity in the market. Why? Because corporations were making tax payments and the Treasury surprised the market with issuing a bunch of bonds. So you've heard them come out with their quarterly refunding and manage the market. Oh, we're not going to surprise the market with big bond issuances. But when these numbers start coming into play, and this is all converging into this summer right before the election, like this, the timing couldn't be more prescient. Like it's all happening right as we go into the summer. So those are all the things that the Fed is looking at to manage around liquidity, because they know that lockup in the repo market in September of 2019, it was a warning bell and severe that the Fed had to flood the market with capital because there was a lockup in liquidity. This is when we talk about the Treasury markets getting dysfunctional. That's what we're talking about. And so those are all the things that the Fed is looking at, Dave. And that's when, that's how they're measuring this. They're not looking at just inflation. They're looking at the Treasury market and making sure that it's all functioning properly. Right.
And it brings us full circle. The fact that Powell goes on 60 Minutes before anyone sees the cracks in the foundation or sees the holes in the dike and him putting the finger, you use your whatever analogy you want, is telling. I mean, we know there's issues. We do. And we know that the Fed is being asked to do something unprecedented, which is work with a dysfunctional fiscal policy. And it's different. I mean, look, you say what you want about the pandemic response, and I think it was horrendous in so many different levels. But the fact, at least, when the economy looked horrendous, at the same time, fiscal policy, dumped liquidity at the same time as the Fed, and it was intentional, right? The difference is the fiscal policy hasn't stopped, and the Fed, as Mike put it, and the reason that Mike's been wrong isn't because Mike was wrong. It's because in the history of our government, in fact, of the Western world, you've never had a situation where the federal government, the fiscal authorities, abdicated responsibility over the economy to the Fed 100%. and kept pumping money into the economy. So as the Fed was removing liquidity, the fiscal side of the economy was pumping money in. That's why. I mean, there's no magic here.
Just pumping it. 20% of all jobs created have been created out of DC. So, you know, like this is just nuts, right?
But the point is a lot of people, a lot of the comments in that we get in this thread is, oh, Mike is a doomer, Mike is a this, Mike is a that. I mean, look, Mike, if we had a functional federal government that wasn't asinine, that didn't have Elizabeth Warren tweeting. I mean, she's literally having her staffers tweet. Today, the staffers were tweeting how great it was that they're forgiving debt on behalf of public servants. I mean, you literally have the person, the most powerful person outside of the White House, although her employees are running inside the administration, saying how great it is we're forgiving debt. I mean, just forget objectively, whatever, whether it's bad, good, whatever.
Yeah, I mean, how small it is. The fact is it's a debt jubilee.
That's right. And so when you have the idea of the most powerful person in financial services saying as loudly as she can, virtually daily, that paying back your debt is a bad thing if you can't afford it, what do you think the market response is going to be? Well, the market response is going to be take out more debt. And when you start taking out more debt, what happens? Well, people buy shit. They buy shit and they pump up the stock market. They buy risk assets. They do stuff.
Right.
That's why it's unfolded this crisis.
It's always been kicked all the way up, and now it's been kicked up to the sovereign level. And the sovereign level is saying, yeah, it's okay if you don't pay us back. Yeah.
That is a big deal. I mean, I feel compelled to defend Mike because while we disagree on many things, the fact is if you had asked any of us, said, don't look at fiscal policy. The Fed is going to do X. What's going to happen to the markets? We would have all gotten it wrong. Yeah. Full stop. Full stop. Yeah. No question about it. I don't know anyone who believes otherwise.
The amount of the size of the fiscal deficits has blown me away.
That's right. And that is the reason. And so, remember double entry bookkeeping? Ever learned, anyone who went to business school, you took any level of accounting. The other side of the ledger is basically this huge fire hose of liquidity,
which is exactly so. Which is why the Fed is running. They've got a what they call now a deferred asset on their books because they owe the Treasury $120 billion. Like this is just it's insane. And so instead of having the double. You're basically putting two assets on the book, or you're putting two. You're offsetting a liability on the asset side, right? So it's absolutely nonsensical. But that's what they can do that, and they're just hiding these things, And nobody talks about it. Nobody sees it. We talk about it in our little bubble, but nobody sees it. They're not talking about. You never hear an economist talk about this.
No.
A PhD economist, they just don't talk about it. They're like, it's not a big deal. They'll deal with it later. Will they?
I mean, honestly, no. They're going to inflate their way out. They have to, and it's crazy. I mean, just to contextualize for our audience, if there was no reverse repo facility and the Fed had to borrow, would they really want to borrow short when you and pay 1% more? Plus, the answer is no. They're doing it because there is no bid. And what happens if the Fed had to do 100% of their borrowing at the 10-year level? What would happen, James?
Right, and then what if they exactly that it would implode the you talk about fiscal deficits. You're talking about spending not just $1 trillion on interest payments per year, but over $2 trillion. But what would have happened? So everybody criticizes the Treasury. Okay, now let's step back. The Treasury has not been perfect for sure, but the Treasury is managing the problems out of Congress. It's Congress that is doing it. It's not the Treasury. The Treasury is only managing the fiscal deficit for them. They're basically saying, well, I've got to enable them. That's what my job is. So people have been, I've seen comments and criticism on the Treasury about how they should have been issuing 30-year Treasuries ad nauseum when rates are down at 25 basis points. What do you think would have happened to all of the companies and all of the sovereigns who held the trillions of dollars of debt that's a 30-year duration when they went and turned and raised rates? The Silicon Valley Bank situation would have been widespread across the entire world because everybody would have been in massive mark-to-market loss. And so liquidity would have been drained at a pace that nobody could even imagine. So we were lucky they didn't do that, right? Because there had never been this experiment of running ZIRP, zero interest rate policy, for so long. And they did it for over a decade. And so here's where we are.
And the average U.S. consumer did refinance. I think that was the quote I heard. The average mortgage in this country is less than 4%, 30-year mortgage. They did refinance.
I got mine.
3.35%.
That's me. Yeah, I'm 3.25%. Yep, that's right. I mean, look, Mike, we've talked. I mean, I've been defending you. You've been sitting there just smirking.
I'm enjoying this.
I mean, it's like, but at the end of the day, have we ever seen fiscal policy like this before? And how does a central bank, other than who basically has the ability to monetize or not monetize? I mean, is there even a slight chance that they're going to opt for not monetizing?
Dave, when I saw Powell last night in 60 Minutes, I couldn't believe he basically said, first of all, it is just at the base. Let's go to, just first principles. The fact that we are talking about the Fed so much, that just tells you how broken this system is. Because we're talking about monetary manipulation so much and the person who's in charge of it, right? But when he sat there and responded to the question about, do you worry about the fiscal policy? And he said that, well, we don't normally comment on it. That's not our job to manage fiscal policy. We answer to Congress, who's in charge of that. So we don't like to comment on it, but I'll tell you this, we're on an unsustainable fiscal path. My jaw just dropped when he said it out loud on national television. I was like, wow, we're saying that part out loud now.
Yeah,
because if you remember, the Treasury had put that chart out that I shared, actually the person who found it, and I've got to give her the hat tip to, is Lynn Alden. She found it. And then I said, oh my, this is just crazy, and posted it everywhere, that the Treasury actually said it out loud as a warning message to Congress. Hey, you guys are out of control. You got to dial it back a bit. Right. And so I couldn't find it on their website anymore. I think they took it down. Everybody's got the chart. It's everywhere, but I think they took it down. But it was in there. It was in their statement from last February. We're going to get another, update on the Treasury state of affairs pretty soon here. But the fact that he said it out loud, they said it out loud, the Fed has said it out loud. It's like everybody's kind of talking about it. Like, you guys gotta get your shit together here. You're running massive fiscal deficit at a time that we don't need it, and it's going to cause a problem. It's going to cause a tidal wave of debt on the day that we do need it.
That's Robert Rubin said it recently, and this is why I want to again just go back to this chart a little bit, Misha, if you can show that. Is this sharp plunge in the amount of GDP we're getting from deficit spending is so negative. It's never been that steep on the way down without a significant recession.
For the listeners, what this is showing is just how much actual productivity you're getting from excess spending in the government.
From the Fed.
From the
government, from Treasury.
Real productivity. Yeah.
You're not getting, and it's usually takes a recession to get these things. We haven't had it yet. So to me, it's more obviously just a matter of time. But one thing that's really been changing is in the polls lately, it's becoming much more consensus that people feel the inflation. They're related to the massive pump in liquidity, and they're starting to think that maybe we want to do something about it. And I'm not going to say it's going to do that, but if you get sometimes like that's one thing that Trump picked up on right away. He just figured out what people wanted to hear. Oh, it's bash China. Good, I'll get votes. Oh, it's bash Iran. Okay, good, I'll get votes. Maybe he'll pick up on that, but usually it takes a second-term president to even do that. And I stick with you, Dave. We've never really done that before, have austerity in a recession or when things are tilting that way, but it could. Obviously I'm an eternal optimist. And that's one thing I like to push back in some things. I do enjoy having like you guys done this for almost 40 years, is when I used to be with customers a lot. When I was on the phone with the clients and I had a great idea and 7 people, I'd call up 7 and they all agreed with me and they did the trade. I knew it was going to be wrong. When they all disagreed and maybe one did the trade, I knew it was going to be right. So, but I feed on that. And that's the thing, is I have no bias. I have no positions. And when I put out a view that is completely organic, and I get massive pushback, it almost always triggers at my, okay, they don't like it. You don't get that good feeling, but you're almost always right. And that really kicked in. I want to show you in this last chart. This really kicked in when I was pointing out how China was a basket case 2 years ago. I got so much pushback on that. And now this is what has happened. I'm just showing the U.S. imports from China divided U.S. imports from Mexico are collapsing. And what's also collapsing is commodities. So this is severe deflationary reset kicking in, and you can't ignore the second largest economy in the world potentially going into a depression. I asked myself, what stops it? They're throwing a lot of fiscal monetary stimulus at it, and every day I look at that Hang Seng or the CSI 300 index, they're just not bouncing yet. So to me, that's part of the macro that's really going to matter this year.
It's being propped up, and they've talked about they're putting so many barriers on the trading around this, claiming that all the short selling is illegal, and we don't even know what they're going to do. We really don't know what they're going to do yet.
Yeah, so that was one thing I have to admit from the very beginning. I have to point out is I went to Hong Kong 2018. There was so much pushback from Americans about Tether. It was $2 billion. Now it's almost $100 billion. I want to tilt over to, it's heard out recently, they might go public. They're more profitable, Goldman Sachs, and per employee, the most profitable company in the world. It's like, okay, why? Because this revolutionary technology has gone for the dollar. That's when people start pushing back on the dollar. I'm like, great, where are you going to go? Gold, maybe Bitcoin, but no other fiat currency is even close.
That is true. I mean, so the question, let's bring it back down to what a lot of people care about or watching us, which is, what does this mean from an investing point of view? Well, what it means, in my opinion, is we have a situation where a lot of risk assets might very well get headwinds from from the economy, but tailwinds from liquidity getting injected, because it almost certainly has to be that way. And so the question is, where does that money go? What actually happens? So will China ban people there investing in Bitcoin as an opt-out? Because it certainly feels like that is what's happening. Look, at the end of the day, the Bitcoin market has, it's the single, what will take Bitcoin to all-time highs and well beyond is when GBTC no longer, any of the collateral that was used, Genesis is the one they're talking about this morning. Matt Hogan was tweeting about it. When that overhang is gone. Now, what gets rid of an overhang? What gets rid of an overhang is the fact that there have been large investors who have said, this is an interesting market, but I can't really invest in my size in it. All of a sudden, they say, oh, wait a minute, there is supply and I can invest in my size. And so that's really what's going on. That's
right. It feeds on itself. Right. And so it's going to snowball. It's going to take time. What's interesting is Bitcoin's kind of shrugged off China today, completely shrugged it off.
Yeah.
And it shrugged off the 10-year yield spiking.
Yeah.
And so it's just sitting here, 43,000. What does that tell you? That tells you that money is trickling in. It's going to continue to trickle in, and it's going to continue to build. And who knows? But Bitcoin is super volatile. I couldn't tell you if it's going to go. I would be shocked if it went down to 20,000, but I would be buying more, a lot more, and if I would see it being volatile and continue to move upwards on that volatility through the rest of the year. That's my gut and my check, and it has to do with all of the fundamentals, and it has to do with the halving. It has to do with the ETFs and what you just said, Dave, where you have these RAAs who are just now getting their heads around it and talking to investors about it. They're like, okay, these things have settled down. We know which ones we can invest in. They have liquidity, and so we can start chipping away, just getting a small position in people's books, and that will build on itself. And as more liquidity comes into the market, it brings in larger players.
Well, to me, the big flip will be when. I don't know when. That's the question of big debate. I just think it's going to be later than than Dave or you might think, is when we see this divergent strength in this revolutionary asset versus beta. And that's what I show here. I just show it's 21 ounces of gold per Bitcoin that peaked at 35 at the biggest liquidity pump in history. I just want to see that 21 ounces of gold per Bitcoin tick up when the stock market's ticking down. And lately it's been crocodile jaws. It's ticking down and stock market's taking off. I just want to see it. That's one thing I have to point out. Is
it's totally fair, but you have to put it in context. So 2022, we saw the largest players in crypto go kaboom because of abject and absolute stupidity. I mean, I do think it's fun. I mean, I don't like dancing on people's graves, but I was glad to see OPNX go belly up. That was if you remember, that was Kyle Davies and Zhu Zhu's next venture. So now they presided over 2 flameouts. Obviously, 3 Arrows was far worse. But the fact is that they called the grayscale trade the Widowmaker for a reason. You know, the number of people.
Keep that chart up there, Mike. Yeah. Go ahead, Dave. Yeah.
And so there's that overhang, and that is literally, but that overhang is being chewed through at the top end of the range.
That's
we went from 25,000 to 48. We retraced down into the low 40s, and here we are consistently sitting in this range, and we will sit in this range until that overhang is gone. I mean, we've seen this story before in markets, Mike. You see it all the time, right?
But
it's capping it.
But look at those drawdowns, right? Back in December and in March, right? So you see those drawdowns there. No, left. Yeah. Back in December of 2018, and then of March of 2020, the drawdowns, right? Well, look at how gold sniffed out that recovery before Bitcoin is what's happened, right? So gold sniffs it out right there before Bitcoin does, right?
Oh, this is gold. This is Bitcoin gold ratio. So Bitcoin sniffs it out for Bitcoin. I like to say it's
no. Look at how the market. Look at how the market took off.
Right. Yeah.
Right. And gold took off before Bitcoin, basically.
Yeah, that's right.
And then again, the next one, the same gap happened.
Yeah.
The same gap happened. So the question is Bitcoin going to sniff it out first this time? But I'm with Dave. I think they both sniff it out. They're both going to go higher on this reversal, right? But we'll have the drawdown first. It will be painful.
So we're getting the hook from Misha, and I'm supposed to tell everybody Scott's back tomorrow. So we get that awesome voice and then all the knowledge from Scott, and we don't have to put up with the 3. Are we musketeers or stooges? We'll leave that to the audience.
Vote. I'm sure there would be non-zero votes for both.
All right.
All or none. Yeah.
Guys, great discussion. Thank you. And thank you to our listeners and viewers.
See you next week.
Monday. Cheers.
All right, see you guys.
Ciao.
That's dope.